Welcome to the Deep Dive. Our mission today is pretty straightforward. We're cutting through all the noise to bring you the key insights from Nature Sunshine's Q3 2025 earnings call.
And this was a big one.
A very big one. I mean, we're talking about record-breaking momentum and the official introduction of new leadership who seems really set on accelerating this transformation they've been on.
That's right. This wasn't just, a slight beat. This felt like a real validation of the strategy they've been executing.
Okay.
All those initiatives, especially around digital and just getting their margins in order, we really saw them turn into, all-time high financial numbers.
So our goal today is to break down those numbers, show you where the growth is really coming from, and then dig into the fresh perspective from the new CEO.
Let's do it.
Okay, so let's start with the headline numbers. What did that snapshot look like?
It was exceptional. I mean, the leverage they showed was fantastic. Net sales hit a new quarterly record, $128.3 million.
Wow.
That's a 12% increase year over year, or 11% if you strip out currency effects.
And profitability, because that's what the real story often is.
That's the standout for sure. Adjusted EBITDA also hit a new record, soaring 42% year over year to $15.2 million.
Okay, wait. A 42% jump in EBITDA on just 12% top-line growth. I mean, that's a classic sign of serious operational leverage kicking in.
It is. It points directly to major margin improvements, and that's exactly what we saw. The quality of those sales just expanded significantly. Gross margin was up by a massive 200 basis points. 200. It hit 73.3%. And management was quick to point out this is the highest gross margin they've seen in 15 quarters.
15. That's almost 4 years.
Yeah, a phenomenal internal achievement. And it flowed right down the income statement. GAAP EPS came in strong at 30 cents per share, up from 23 cents a year ago.
Those are just fantastic starting points. So now let's drill down into the engine room of that growth, which for this company really means North America and this digital transformation they've been talking about. NA sales were up 7% to $36.2 million. But the focus of the call was definitely on that digital pivot underneath.
And for very good reason. The numbers they reported are almost unbelievable for this space. The year-over-year growth in their digital business surged 52%.
52?
In a single quarter. The investment is clearly paying off. The number of new digital customers who actually made a purchase more than doubled versus last year.
And when we talk digital customers, we're talking their direct-to-consumer or DTC channel, right? Which is so important because it gets around the traditional field consultant model.
Exactly.
And once they get these customers, are they sticking around?
They are. And that's the key structural change we have to focus on here. Management said their subscription and autoship programs now account for over half of their DTC ordering accounts.
Over half?
Yeah. I mean, think about that. You're moving from this lumpy kind of old school direct sales model to one where half of your digital revenue is predictable, recurring income. That's a whole different ballgame.
It totally changes the quality of the revenue stream. And it suggests they're spending their marketing dollars pretty wisely. They kept mentioning CAC and ROAS.
Right. Customer acquisition cost and return on ad spend.
For anyone unfamiliar, can you break those down?
Sure. CAC is just how much it costs to get one new customer in the door. ROAS tells you how much money you get back for every dollar you spend on ads. And management confirmed they saw, meaningful improvements in both.
So they're getting customers for cheaper, and those customers are spending more faster.
Precisely. And that's exactly why they felt so good about increasing their ad spend this quarter. I mean, if economics are that strong, you absolutely pour fuel on that fire.
And they even gave us a specific win, didn't they? Something about a social channel.
They did, yeah. In the Q&A, they mentioned TikTok has become a particularly successful new social commerce avenue for them.
Interesting. So that shows how modern their acquisition strategy is becoming. It's not just Google ads anymore.
It's a strong signal of agility. Now, while North America is handling that transformation, let's pivot internationally, because Asia Pacific was the real growth powerhouse this quarter.
What were the numbers there?
The segment grew 17% year over year, or 15% constant currency, to $64.7 million.
Okay, and within APAC, we saw some huge individual market numbers. I've got them here. Japan up 32%, China up 36%, Korea up 12%. That China number is really something else, given all the economic headwinds we hear about.
It is. And the reason for that strength, they said, is directly tied to them basically copying the North American playbook.
The subscriptions.
The subscriptions. The recent launch of their autoship program there has just taken off. It already accounts for 12% of sales in a really short time, and it stabilized the business, even though, and they were clear about this, the macro environment in China has not gotten better.
So that just shows you the power of that recurring revenue model. It can kind of transcend the regional economic noise.
It can, but the call did have some important warnings. Management gave some context on Q4 that you absolutely have to understand, especially for APAC.
Okay, let's hear it.
You have to remember the lumpiness that's still in this business model. They said about $2 million in revenue was actually pulled forward from Q4 into Q3.
A timing issue.
A timing issue, exactly. It was due to some specific field activation programs. So you take that $2 million pull forward and you combine it with the fact that Q4 of last year was an incredibly tough comparison.
Right. They grew like crazy then.
They grew 21% in constant currency. So because of those two factors, the outlook for APAC growth in Q4 this year looks tricky. They expect it to be flat or maybe even slightly down.
So it's not that the business is getting worse, it's just the timing and the tough comps are distorting how it looks quarter to quarter.
Now that's the key. Meanwhile, Europe just keeps on performing. It was up 13% or 10% constant currency to $22.1 million.
And where were the bright spots there?
Central Europe grew 10%, mostly from their expansion into the Baltics, and really strong demand for their professional-grade Pro Power line.
Okay.
And Eastern Europe was even more impressive, growing 14%. They said it was just down to better product availability and great execution, which is just, it's remarkable given the instability in that region.
Let's go back to that gross margin number, that record 200 basis point jump. An improvement that big suggests something systemic is changing. Mm-hmm. What did they say was driving it?
Management was, they were very firm that these improvements are structural.
Which is what you want to hear.
It's exactly what you want to hear. They attributed it to a few ongoing things: renegotiating logistics contracts, better manufacturing efficiency, smarter global sourcing, and, just a more disciplined approach to pricing.
So a long-term playbook, not a one-off benefit. And they think it's sustainable.
They do. Looking ahead, they expect gross margin to settle into the upper 72% range for next quarter and into 2026. And that's even with a small headwind they're expecting from tariffs. That upper 72% level is a fundamental structural change for this business.
It really is. Now, what about expenses? SG&A was up by about $4.7 million.
It was, but they framed this as a strategic choice.
Right, this goes back to the ad spend we were talking about.
Exactly. They weren't shy about it. The increase was almost all driven by that digital ad spend because the Sanimai and ROAS metrics were just too good to pass up. They're capitalizing on a clear opportunity. They're buying growth when the economics work.
Makes sense. And just a quick note on the balance sheet, which looks rock solid. They've got $95.6 million in cash and absolute zero debt.
Yeah, that financial strength gives them a ton of flexibility. They did mention inventory dropped because Q3 demand was just so strong, and they'll rebuild that in Q4. And importantly, they're still buying back their own stock.
Right.
Almost $14.5 million worth of shares so far this year, with nearly $20 million left on that authorization.
Okay, so connecting all these pieces together, management showed a ton of confidence by raising their full-year outlook, and not by a little.
No, not at all. Yeah. Net sales guidance was raised to a range of $476 to $480 million. That's 5 to 6% year-over-year growth. But the profitability raise, that was the really dramatic part.
What was it?
Adjusted EBITDA guidance was raised substantially. It's now $47 to $49 million, which implies 16 to 21% year-over-year growth. That margin expansion is flowing right through to the bottom line.
But just to put that in context for Q4, we have to reiterate that the implied guidance for just that quarter looks a bit soft because of the timing issues we mentioned.
Right. The implied Q4 revenue is somewhere between $120 and $124 million, and EBITDA is about $9.6 to $11.6 million. That sequential dip is modeled in. It's really important for you not to see that and think the business is weakening.
It's all about the pull forward and that crazy tough comparison from last year.
Exactly.
All right, let's turn to the new voice on the call, the CEO, Ken Romanzi. He comes from a deep CPG background, B&G Foods, Nabisco, Hasbro, giants.
Yeah, and you can already tell he's looking at this company through a very different lens than a traditional direct sales CEO might.
What do you mean?
Well, first, he's very happy with the strategy that's already in place. But his analogy for the business was fascinating. He views the company's huge network of consultants and practitioners hundreds of thousands of them as being like managing a network of independent entrepreneurs.
So not just salespeople. He actually compared it to managing independent soft drink bottlers or the big route sales forces at Frito-Lay and Nabisco.
Right. And what that suggests is a professionalization of the whole channel. It implies that if you treat your consultants like real business owners, then your job as the corporation is to manage the brand, the supply chain, the marketing tools.
The things you control.
The things you control. You manage those things with CPG-level precision to make them more successful. It shifts the focus from just recruiting more people to making the existing base way more productive.
That is a really crucial distinction. He also noted that the business is perfectly lined up with the health and wellness mega trend, as he put it.
Absolutely. For his first 100 days, he says he's just focused on learning, spending time with leaders on the ground in North America, Asia, Europe. So he's not signaling some massive immediate change. It's more of a CPG-style refinement of the plan that's already working.
All right, now for our favorite segment. This is where we pitch a high-conviction, maybe outrageous, but plausible trade idea based on the call. And we have to stress, this is just for fun and analysis. It is explicitly not financial advice.
Okay, so the whole setup here is about the perception gap. The market has for years valued Nature Sunshine based on its legacy.
As a lumpy, kind of unpredictable direct sales company.
Which gets a lower valuation multiple. But we just spent the last 10 minutes laying out all the evidence that the company is rapidly, and I mean rapidly, changing that.
Right. We've seen the pivot to high retention, recurring revenue with autoship. We've seen the structural gross margin improvement that they expect to hold in that upper 72% range. These are the signs of a much higher quality business.
So here is the outrageous trade pitch. We think there's a near-term market arbitrage opportunity. Because of that sales pull forward and the really tough Q4 comp, the Q4 earnings report headline is probably going to look negative.
A sequential decline in revenue and EBITDA.
Exactly. And we think generalist investors, the ones who just react to the headline, are going to see that deceleration and they're going to sell.
So the trade is to buy that dip. Buy it aggressively when those Q4 numbers come out and then hold into 2026.
That's the trade. Because you're betting the market is not yet fully appreciating how sustainable that upper 72% gross margin is, or how reliable that recurring revenue base is becoming.
So the idea is that by the first quarter of 2026, when the tough comparisons are gone and the new, stable, high-margin model is clear for everyone to see,
the market will have no choice but to re-rate the stock. The valuation multiple will shift from a lumpy direct seller to a high-margin recurring revenue wellness platform. And that re-rating is where the potential return comes from.
that is a bold bet on ignoring the short-term noise to focus on the long-term structural story.
Yeah.
Okay, so to recap, Nature Sunshine delivered a record quarter. It was driven by massive digital execution, a shift to recurring revenue, and real sustained margin improvement.
And the key takeaway, I think, for everyone listening is that these subscription autoship programs are working. They are successfully transforming a really complex old model into a fundamentally stronger recurring revenue machine. That is where the long-term value is going to be created.
And we'll leave you with this provocative thought to chew on. The new CEO, Romanzi, sees his field consultants through a CPG lens, focused on brand support and professional tools. But the core of this business has always run on the passion and personal relationships of those practitioners. How quickly can he professionalize the brand and the marketing without alienating that core base and maybe risking a cultural backlash? Something for you to mull over.
And remember, the opinions expressed here are solely for informational purposes. They should not be considered investment advice. Please consult a professional before making any investment decisions.
Thanks for tuning into the Deep Dive. We'll catch you on the next one.